Nobody, and I mean nobody, likes a stock market crash, especially those in retirement. However, there are a few strategies that can be implemented that can potentially put you in a better spot when the market recovers. So here are 3 main strategies that we call our clients with and implement during times of economic turmoil. So number 1 is tax loss harvesting. And this is for the brokerage accounts, non-IRA accounts. For example, if you own ExxonMobil, we would sell ExxonMobil and immediately buy Chevron. In this case, we're able to lock in a tax loss while still maintaining an investment in the energy sector. Therefore, when the market recovers or when the energy sector recovers, you're still taking advantage of the recovery. However, you have a tax loss for that year. Now you're able to take that tax loss and use it to capture potentially a much needed gain. A common one that I've seen with multiple clients is they've had Amazon for decades and it has grown and is crowding out the other investments within their portfolio, but they've been hesitant to sell it because they don't want that long-term capital gain because they're high earners. And so we can take advantage of a crash, which is temporary, lock in a loss without getting out of the investment sector, and then we can trim some of these stocks that are at a gain. For example, again, Amazon during COVID kept climbing when everything else was crashing. So great time to sell something like that while taking advantage of the loss. Now, speaking of this, I do have a separate video on my channel that breaks down this exact example. The reason I'm using these investments is this is a real life example that we did for a client of Chevron, ExxonMobil, and Amazon. The video will be linked in the description below. The second strategy that we're commonly calling clients about during a stock market crash during their retirement is Roth conversions. Now, the strategy here, while the market is down, is it provides an opportunity for an investor to convert the same amount of shares they normally would, but at a much lower value, therefore a lower potential tax bill. Now, the kicker to this, the sweet part at the end, the cherry on top, so to speak, is the newly converted shares, since you converted the same amount that you normally would, just at a lower value, are now inside the Roth IRA. And so when the market does recover, it's recovering in a completely tax-advantaged environment. So this is, again, a very common thing that we call our clients about and look at it as a massive opportunity during a stock market crash. Now, the third tactic that we use is probably one of the most common, and it's actually something that people do the reverse of quite a bit. This is called rebalancing. In a general retirement portfolio, you may have some stock market investments, but then you may also have some conservative investments such as CDs, treasuries, maybe some insurance products that typically stay fairly stable or can even increase in value during a stock market crash. The idea is for rebalancing is you want to take advantage of the low value in the stock market. So you skim some cream off the top of your conservative investments and buy low in the stock market. I know sometimes that's really hard to do, especially during the news headlines and things going on. But what we've seen is if people would do that and buy low, as the market recovers, you can rebalance again, but do the opposite. Skim the cream off of the aggressive investments as it recovers and place it back into the conservative side. No one has a crystal ball, yet often people act as though they do. What I mean by that is typically during a stock market crash, people make the mistake of getting completely out, selling after it crashes, and they say to themselves, well, I'll get back in when things improve. However, the mistake lies, and this is facts, I'll put it in the video description below so you can see the source yourself. The best days in the stock market, even over the last 30 years, have been closely intertwined with some of the worst days. And so when you sell your aggressive investments during a crash and flee to safety, you will miss the best days waiting on the sidelines. Therefore, in the last 30 years, you would have almost cut your returns in half by doing that. Whereas if you implement this strategy, you're getting the best of both worlds. I like to equate it to a sale at your favorite store. When it's 20% off at the store, you want to run to it rather than running away from it. And so again, this is just another opportunity that we use during crashes to put our clients in a better spot. Now, if you're interested in any of these strategies or more, click the link in the video description below. We'd love to schedule a complimentary one-on-one session just with you to discuss your needs and your concerns. We look forward to speaking with you.